Hello, I am Mr. Jackie and welcome to my workshop channel. In my channel, I will share with you my personal insights, tips, analysis and entry strategies for investing in the international gold market. If my views can help you to get good returns and profit, please help by liking, subscribing and sharing my videos with your friends, and feel free to discuss and contact me in the comments section. Thank you all. International spot gold prices fluctuated sharply last week, with a low rebound prevailing throughout the week. On Monday, the gold price held on to the important support at 1936.65. On Tuesday, the market broke through the support at 1936.65, and then market maker lured short sellers to see the lowest price at 1932.01 and rebounded. The rally extended to a full week high of 1983.41 from Wednesday to Thursday. The market closed at near the day's low on Friday. Gold prices continued their technical rebound upwards after the release of the CB Consumer Confidence (MEC) data last Tuesday at 102.3, which was significantly better than the market expectation of 99 but weaker than the previous value of 103.7. Last Wednesday evening, the U.S. House of Representatives passed the debt ceiling bill with a 75% majority, and on Friday the Senate finally passed the bill with 63 votes for and 36 votes against. On the same day, Friday, the U.S. released May unemployment and non-farm payrolls data. The May unemployment rate was 3.7%, worse than the market's expectation of 3.5% and the previous value of 3.4%. The May non-farm payrolls result was 339K, significantly farther than the market's expectation of 190K and the previous value of 294K. Spot gold was affected by the non-farm payrolls result and the news of the final passage of the U.S. debt ceiling. Gold prices fell sharply. The price of gold fell sharply on news of the non-farm payrolls results and the final passage of the U.S. debt ceiling. Last week, spot gold reached a high of 1983.41 and a low of 1932.01, with a volatility of $51.40 for the week, and closed at $1,946.86 per ounce. My personal analysis is that there are three major factors that influence the future direction of the international gold price. 1. The U.S. geopolitical and diplomatic strategy, the ongoing war between Russia and Ukraine and the impact of the U.S.-China trade war. 2. The accelerating pace of global de-dollarization. And 3. The future direction of the U.S. monetary policy. As China and the U.S. engage in trade and diplomatic battles, the U.S. economy has been severely impacted and depleted, and the ongoing war between Russia and Ukraine has led to rising global crude oil prices, food shortages, and persistently high inflation. At the same time, the U.S. economic sanctions against other countries and the continual raising and extension of the debt ceiling have contributed to the rising sentiment and pace of global de-dollarization, all of which are fundamental factors that will favor the rise in gold prices and the challenge of reaching new record highs. With the passage of the U.S. debt ceiling bill last week, the market should focus more on the U.S. Federal Open Market Committee (FOMC) interest rate meeting on June 14 to 15 this month. From the economic data released by the U.S. in recent months, the overall results are still mostly mixed, and another increase in interest rates will deepen the weakening of the liquidity and attractiveness of U.S. bonds, with the focus on the deterioration and crisis that could trigger another wave of U.S. bank failures. Since the Fed raised interest rates last month, May, it should be more cautious in observing more economic data results in the future before making monetary policy positioning and decisions. Therefore, I believe that the Fed will be unlikely to raise interest rates in June in the short term. Technical analysis shows that after the surge in spot gold from a low of 1804.59 on February 28 to a new record high of 2077.86 on May 3, there was a healthy profit-taking correction in the gold price. Last week the spot gold price broke through the important support at 1936.65, and then market maker lured short sellers to see the lowest price at 1932.01 and rebounded. Spot gold price climbed to the weekly high of 1983.41 resistance last Friday and completed the fourth wave before starting to fall sharply, and is now entering the stage of completing the final fifth wave. The 5 waves in this set of consolidation waves: first wave 2077.86 down to 1999.36, second wave 1999.36 rebounding to 2048.15, third wave, 2048.15 down to 1932.01, fourth wave, 1932.01 rebounding to 1983.41, fifth wave, 1983.41 down to, forecast, 1939.25, 1919.16, 1912.37, 1908.97, 1900.24. As the gold price is entering the last, fifth, wave of this correction wave last week, after completion, spot gold will enter the next upward push wave and challenge new record highs. Therefore, this week's investment strategy should be to absorb gold at low levels as a medium to long-term hedge and to obtain high-yield returns. Note, range of error, -$4.60. Key U.S. economic data this week, Monday, June 5th, U.S. ISM Services PMI, May forecast, 52.3, previous, 51.9, factory orders, April, forecast, 0.8%, previous, 0.9%, Wednesday, June 7th, U.S. trade account, forecast, -$75.2 billion, previous, -$64.2 billion. Strategy recommendations for this week. Resistance, 1963.77, 1976.16, 1987.72, 2004.93, 2022.14, 2043.43, 2057.29, 2114.32, 2167.99. Support, 1944.14, 1939.25, 1919.16, 1912.37, 1908.97, 1900.24. Major range for the week, resistance, 1983.41, support, 1939.25. Daily market resistance, 1963.77, support, 1939.25. Note that the strategy has been to take long positions at lower levels. It is recommended that gold prices this week are close to *1939.25 to try to take in, break 1932.01 stop loss, at 1919.16, 1912.37, *1908.97, *1900.24 near the support level can continue to try to take in, break support level -$4.60 stop loss, medium to long-term profit target 2114.32, 2167.99. This is the end of this issue. The above analysis is purely my personal opinion and is for your reference. I look forward to seeing you all again in the next issue. Thank you all.